Well, good morning, Robyn and Brooke.
Hey, Paul. Hi, Brooke.
We welcome all the folks that have joined this program for a webinar. This is almost like one of those deja vu moments. We thought, we all talked internally, we thought we were done with PPP loans, that we would never have to deal with this again. And lo and behold, we were delivered a gift right there at the end of the year of 2020. So we're starting off 2021 with another PPP loan program, even an expanded, enhanced program. We've spent some time looking at the bill. I'm sure everybody's heard about the 5,600 pages of legislation, and it is a rather large bill. Much of that bill, frankly, was to fund the government through September 30th. It's the normal omnibus budget reconciliation package, but there were some significant items in there related to COVID relief, including PPP loans. We won't be able to cover all of the COVID relief measures, but we will hit the items we think are of most interest to small and medium-sized business owners. It's important to understand, if you go back to your 7th grade civics class, it's important to remember that Congress, as the legislative part of our federal government, passes laws. It's the executive branch, such as the IRS and the SBA, those agencies that issue the rules that tell us how to apply those laws and interpret those laws in terms of executing upon some of these items. So we have yet to see any rules issued by IRS or SBA on the items we're going to cover today. You'll probably hear us mention that on a couple of occasions because we are anxiously awaiting some of those rules. But we thought today it was important to get this information out about some of these new and expanded relief programs so that you can begin to get prepared to take advantage of these items if they're pertinent and if they're applicable to you. So today what we hope to accomplish is go through some of those new and expanded relief items, touch on some of the tax guidance we received as a result of this bill, and perhaps some impacts on 2021 tax returns even. And then we want to close up the program with what we think is an action plan for you to take away from today, things you can begin working on today to get prepared that when these rules are issued, you're ready to go and take advantage of these items. We will also be monitoring Q&A. So if you're familiar with Zoom, or if you're not familiar with Zoom, I believe if you move your cursor to the bottom of your screen that you're viewing this program from, there'll be a toolbar that will pop up, and there is an item there where you can click on Q&A and submit questions to us. On this webinar with me today is my partner, Robyn Pye, down in Katy, Texas. Good morning, Robyn.
Good morning, Paul.
How are things in Katy this morning?
Things are good. Sun is shining. It's a good day.
Okay, a little cloudy up here in Estes Park today, but we hope the sun will come out, and we might even hit 40 degrees here today.
A little warmer than that here, as you can imagine.
Yeah. And also on the call today is Brooke Hupp, our Director of Accounting Services. Brooke's going to help us take some of these concepts we're going to talk about. And for those of you that are QuickBooks Online users, she's going to help you today show you how you can access your data to see if you qualify for some of these items. So Brooke, good morning to you. Looks like you're in Loveland, Colorado today.
Yeah, I'm in the office for the first time in over a month. So kind of nice to be out.
It sure is. So for those of you that may not know, here in Northern Colorado, we just recently moved to what they call level orange, which means we can have up to 25% office occupancy right now, which if I do the math on that, we round that up that we can have up to 2 people in our office at any one time. This remote-based work we've been doing now for 9 months. It's almost becoming the new normal. So, but it looks like Robyn, you're in the office. Brooke, you're in the office. I'm sitting up here in Estes Park at 8,200 feet. So we're making it work. That's for sure. So let's get with the program today. this sort of gives you the overview of what we're going to cover today. So if you remember that bill that was passed and signed into law about a week and a half ago, I believe the total price tag for that bill was somewhere north of $2 trillion. And again, like I said, much of that was the normal annual funding of programs and agencies for the fiscal year ending September 30. But what we're going to focus on today for the most part is the $325 billion that was set aside specifically for some of these COVID relief measures. And so the biggest one, and the one that's getting most of the news, is the $284 billion for this renewed, revised PPP loan program. We're referring to it as PPP2, just so we can remember which program we're talking about. There was $15 billion set aside for what they refer to as shuttered live venues. We will not be touching on that particular program today. There's $20 billion set aside to revive the EIDL Emergency Grant program. We will talk about that particular program today because it could have some applicability for the folks on this call. $3.5 billion for continuing the SBA debt relief program. We will be touching on that particular program as well. And then $2 billion to support various SBA lending enhancements. We're not going to get into that, but there's been some fee waivers, enhanced government guarantees on some of those loans to maybe help those loans be more achievable, maybe to more borrowers. But we won't get into that particular part of it in any sort of detail. So let's jump into the PPP loans. This is a revised and enhanced, resuscitated type of program. If you were with us all of last year with the webinars we had about PPP loans, you know that we were very aggressive in promoting these types of loans for clients that were eligible for them. That program expired, I want to say it was around the middle of August, I believe, and there was money left over. It was not fully subscribed when they added more money to the program in June. It expired in August and there was money left over, but that program expired. So in the act that was passed a week and a half ago, they created two types of PPP loans. One is they basically resuscitated what we refer to as the first draw program, which was the original PPP loan program. And here in a few minutes, we'll get into what's referred to as the second draw PPP loans for people who already got their first PPP loan last year. So this PPP loan first draw program, this is for folks that for whatever reason did not get a PPP loan last year. Perhaps they were in a type of business organization that was ineligible to get a loan under the original PPP loan program. So many of the rules for this first draw program resemble the rules from the original program, but then added some additional eligibility. So, a couple items here. Your business had to be in operation as of February 15th, 2020. That was kind of a magical date. And you still have to be in business, obviously, today to be able to get this loan. It's open to any small business concern, 501c3 nonprofits. Those are the charitable organizations, and self-employed individuals are also eligible to this program, just like they were eligible last year. You have to have 500 or fewer employees, and I'm sure for the folks on this call that you probably meet that particular threshold. What's new is they expanded the eligibility to numerous types of organizations, and the two that probably are catching the most attention and maybe have the most applicability to our client base are these 501c6 organizations. So let's understand 501c is a section of the Internal Revenue Code that defines various types of organizations that qualify as nonprofits. Perhaps the one that most people know about is the 501c3 group, which refers to charitable organizations. 501c6 refers to business association organizations such as chambers of commerce, trade groups such as the Colorado Brewers Guild is a trade group. Some communities have a local board of realtors. Those are trade groups. And then in some areas, we have economic development organizations that are looking to attract employers to their particular geographic area. In many cases, those economic development organizations are 501c6 organizations as well. So those groups are now, they were not eligible last year for the original program, but they are eligible as first draw borrowers under this revised PPP loan program. Also, we have what are referred to as destination marketing organizations. And Robyn, I'm not sure if this is something that's big in Texas, but here in Colorado, a lot of communities have these destination marketing organizations. Typically, they're taxing jurisdictions. They assess a sales tax, or it's usually referred to as a lodging tax or a pillow tax. But they're funded through these tax assessments, and then they use that money for marketing purposes to try to attract tourists and guests to their particular organization. A very popular program here in the state of Colorado. Those destination marketing organizations are now eligible for this first draw PPP loans, and they were not eligible last year. Now they have to have 300 or fewer employees, and they really have to restrict to the extent that they participate in any kind of lobbying activities. So there's going to be some of those trade associations who have offices in Washington, D.C., who are walking the halls of Congress and doing lobbying. They're not going to qualify for this, but chances are your local chamber of commerce, perhaps your state trade association, professional business association could qualify for this type of loan. In terms of determining the loan for these first draw, first-time borrowers, many of the rules from the original program stayed the same with some enhancements. The loan is still the lesser of $10 million or 2.5 times the average monthly payroll costs. Those payroll costs can be based either on the calendar year 2019 or the 1-year period prior to the loan application. Being that we expect these loans to begin opening up this month, that 1-year period as a practical matter would be 2020. So as someone considering getting this first draw loan, you would really want to look at your 2019 payroll and your 2020 payroll to see which ones provides a bigger base for you to determine that 2.5 times the average monthly payroll costs. As it notes here, seasonal employers, and again, that would be popular here in Estes Park because most of our businesses make their money during the summer, and then they typically are relatively dormant during the off season. Seasonal employers can use any 12-week period, and we've got the dates there to determine those payroll costs for the calculation. Payroll costs for the most part stayed the same, but there were some expansions in this. Again, the wages, the retirement plan contributions, the state unemployment taxes, those rules stayed the same from the original PPP program. The benefits, which originally included group health insurance, has now been clarified and extended to include pretty much all types of group health-related benefits. And we've got listed here the items like dental, vision, AD&D, disability, and life insurance. Those group the expenses for those group benefits now go into that payroll cost calculation. Now we have the second draw program. So this is applicable to folks who already got their first PPP loan last year in 2020. They now have a second bite at the apple to come back and apply for a second PPP loan. Again, the business must have been operational as of February 15th, 2020 and still be operational today. They did impose some restrictions on this particular program in terms of the eligibility requirements, that you have to have 300 or fewer employees to qualify. You must be able to show that you fully spent your first PPP loan, that it's exhausted, that it was used for all those other items. This is one of those items, again, we don't know what that proof looks like. We don't know what the lenders are going to require in terms of a certification that you spent your PPP loan, but it's there, it's in the law, and we'll see how the rules work that out. The biggest item that to qualify for this second draw is they didn't want to allow the original PPP loan folks just to come back and get a second loan. They wanted to make sure they were benefiting companies that were truly negatively impacted by the pandemic. And so they created this quarterly revenue test that during a calendar quarter of 2020, your gross receipts, your top line income on your P&L declined by 25% or more compared to the same quarter in 2019. For companies that began business in 19 who weren't in business for all of 19, or maybe who started business early in 2020 prior to that February 15th date, there's some other rules that apply in terms of how you compare those quarters. But by and large, most folks that were in business for all of 19 and all of 2020, it's a quarter by quarter test to see if in any quarter your gross receipts in 2020 were 25% or more less than what they were in 2019. And Brooke, I'm going to ask you, I'm going to stop sharing here. If you can walk folks through how to generate these types of quarterly reports so that they can see for themselves at a very top level whether they qualify for that or not. Help folks walk through that.
Sure. So I started sharing my screen. Can you see the QuickBooks I have open here?
Sure can.
And this is a sample company file. This is not any of our clients. So what you're going to do once you're in your QuickBooks, down on this left side here, select reports. And then you're going to select the profit and loss. And here's where you want to go, and you're going to change the date to last year. And you want to change this display columns to quarterly. And then under the compare another period, if you click the arrow there and select previous year, and then select percent of change for that one. Now here on the accounting method, it depends on how you file your federal tax return. You're going to want to make this match. So if your federal tax return is cash basis, you'll select cash. If it's accrual, you'll select accrual. I'm just going to go ahead and do this one accrual basis, and then you're going to select run report. So then what it does, it opens up your P&L. I would recommend coming over here to the income, and there's this little arrow. If you click that, that's going to condense if you have multiple income accounts. It's going to collapse them down so that you can look at this total income line, because that's the line you need.
And Brooke, let me just reinforce, that's important because it's not a single line or a single source of revenue that has to be 25% or more lower than it was in 19. The law says gross receipts. So that's why you want to basically collapse that. If you're tracking multiple revenue streams, you want to collapse that into a single line for that top line income, because it's a gross receipts test.
Right. So if you collapse it, that's going to give you all of them and make it a little bit to make sure you're grabbing the right line. What I did, I just exported this to PDF so we could see more of it on the screen a little better, where I've collapsed the income line. So if you look across first quarter, comparing 2020 to 19, they were up almost 9%. That's before the March 15th when coronavirus really started shutting things down. Going into the second quarter, though, they were down over 66%. So they qualified right there by hitting it just that one quarter. Go to third quarter, they were down 15%, which wasn't as low as the 25, but they still qualified because of the second quarter. And then look at the fourth quarter, they're down 43%.
Hey, Brooke, can I make a quick comment? Sorry to interrupt you, but
Sure.
Your first draw PPP proceeds, or if you got the PPP loan from the original CARES Act, that does not count as gross receipts. So we had a question on that. So I just wanted to throw that out there. So if for some reason in your accounting software, you have that up in your income line, you're going to need to pull that out in order to do this comparison.
If you would have that up in the income in one of the, if you have a bunch of different accounts up here and you would have that up there, just go change that account. If you've got it set up as an income account, go in and change that PPP loan down to an other income, and then it'll kick it down to the bottom and won't include it up here in the top.
Yeah, that's a great, go ahead.
If you need it, and if that's something you need help with, definitely give our office a call. Any of the pro advisors here can help you get that moved so it shows up correctly. Again, that's the great thing about QuickBooks Online. Give us a call. We can hop right in and help you pull this report.
Yeah, and I want to reemphasize that it only takes one quarter. It only takes one quarter in 2020 to qualify you for the second draw loan. So as Brooke showed, you know, that third quarter they were down 15%, so they don't meet the threshold. First quarter they were actually up 9%. They were on track to have a great year, so they don't qualify. But it's that second quarter. In fact, the fourth quarter is down 43%. So either one of those quarters qualifies you for that second draw loan. It's not across the board that every quarter had to be down. It's just the one quarter creates a trigger to make you eligible for that second draw PPP loan.
Yeah, and one more comment on that. We've got a team of folks that are looking through our QBO clients doing this exact analysis. So, you know, if we think you qualify, we will be in touch, but if, you know, it's going to take us a while to get through the list. And so if you're curious as to whether or not you might qualify, Brooke's done a great job of showing you here how you can go in and check your own records.
And Robyn, you know, the other thing you and I talked about the other day is if your books aren't caught up through the end of 2020, let's say, you know, you've been with the holidays, you've been busy and you just haven't done your record keeping for perhaps November, December, you got to get that done. You've got to get that. You've got to get that caught up, because I mean, I expect the banks to start accepting these loan applications, perhaps, you know, by the end of next week. And I don't know, you know, nobody knows how long this $284 billion is going to last. So
right.
if you think you're eligible, get your books caught up. Let's get these numbers pulled together. And if you're eligible, by gosh, let's be on it and act quickly.
Yeah.
I'd like to add back to this accounting method. If you have a question on that as to which way to go, definitely that's another thing. You can email our office, email one of us. We'll be able to help you with that. You do want to make sure you're pulling it the right way. Certain types of businesses, construction, that may invoice in their QuickBooks, and you know, a lot of those, for especially big jobs, you could be setting out 90, 180 days on getting paid. And if your tax return is cash basis, but you're running your accounting accrual basis because you want to see that stuff, and you invoice someone $100,000 in June or in September, but you still haven't gotten paid for it, and you run this report accrual basis, it's going to be added in there, where, because cash basis doesn't count the money until you receive it. So if you have a question on that, please reach out to one of us, because we'll be able to make sure you're pulling it the same as your tax return.
Great point. Great point. And by the way, Brooke is monitoring the Q&A box. So, you know, if you do have questions, please don't be shy about submitting those. You know, we're prepared to take those questions as they come. And certainly at the end of this program, we'll stick around as long as it takes to answer all of your questions. So now in determining the loan amount for the second draw, since you've already had your first loan, the limitations are a little bit different. Here, the loan is the lesser of $2 million or 2.5 times that average monthly payroll cost. And at the bottom there, you see the payroll cost list. It's the same as what we looked at for the first draw. It's the same calculation of the qualifying payroll. Again, it can be based on 2019 or the 1 year period before the loan, which right now would be the 2020 calendar year. The seasonal rules the same. Everything's the same. The one item they did carve out, though, is this is for businesses that have a NICS code. And I don't remember what it's, North American Industry Classification System. I hope that's what the acronym stands for. But they have these codes for various industries and types of businesses. And there's a NICS code that starts with 7.2. And this is for accommodation and food service businesses, which, when you think about it, have been particularly hard hit during this pandemic. These are bars, restaurants, hotels, bed and breakfast, you know, any type of lodging business. Those businesses that start with a 7.2 for their NICS code, their loan amount can be based on 3.5 times their average monthly payroll cost. So if you think about it, if you're not a bar, restaurant, or hotel, and you got a PPP loan last year, and you had a significant decline in one of those quarterly revenues of 25% or more, generally your second draw PPP loan is going to be just about the same as it was for the original PPP loan you got. But if you're a bar, restaurant, or a hotel and you meet these qualifications, your loan is going to be about 40% larger than the loan you got last year. So it's a significant carve out, a significant benefit. And I can hardly imagine a bar, restaurant, or hotel that doesn't have a more than 25% decline at some point in one of their calendar quarters of 2020. So it's a real benefit. I'm thinking, about some of our Estes Park businesses up here that fall into that category. This is their off season right now. It's a fairly dormant period of time. And to get a shot in the arm right now with one of these PPP loans to perhaps carry you until the season begins to pick up late March, April, or May, it could not have come at a better time. I'll just leave it at that. So, Robyn, if you want to walk us through some of the forgiveness rules for these PPP loans.
I can do that. So if you remember, the name of the program is Paycheck Protection Program. That's where the acronym PPP comes from, but it is a reminder that, the original intent of these loans was to keep people working. And so when we talk about forgiveness, there's a certain percentage that needs to be spent on payroll, and that remains unchanged. So 60% of your costs should be spent, of your loan should be spent on payroll costs. The categories of forgivable expenses haven't changed. They haven't taken anything away, but they have expanded some of that. So Paul had mentioned before, payroll costs, that includes, of course, wages. It includes group health insurance, retirement plan contributions that you make on behalf of your employees. It does not include employer payroll tax. I think there was some confusion on that the first time around. What has been added into that payroll cost is those other group benefits that you might be providing, the dental, the life insurance, things of that nature. Rent, mortgage interest, and utilities still are in this forgiveness bucket. A reminder, the way I understand it, those contracts still had to be in place prior to, I believe it was February 15th of 20. So new leases and things, you might need to be careful and look at those closely. They added some new costs, some new categories of expenses that qualify for forgiveness. Supplier payments to sustain operations for contracts. Paul, do you have more information on what exactly they're referring to? That seems to be very broad.
Yeah, I think it's more like, take a restaurant, for instance. They have contracts with food service companies, okay, and they buy a lot of inventory to carry themselves, maybe for 3, 4, 5 days. So those
Gotcha.
those are supplier contracts that are critical, okay, to their operation. Okay. So I think that's the focus is on sort of the critical
gotcha.
supplier payments.
Okay, all right, that makes sense. So payroll fees. So most of you are paying costs for for your payroll service. So now those costs can be included in forgiveness. Accounting fees. If you've had to pay to modify your business or your structure to, adhere to social distancing guidelines, those costs can now be included, as well as if you've had property damage related to protest activities that has not been reimbursed by your insurance. Certainly hope that's not the case for anyone in this group. You can still choose a covered period between 8 and 24 weeks. So that has not changed. So the main difference here is just the adding of the new costs that now qualify under the forgiveness bucket.
So Robyn, if I can just, this may sound a little self-serving. If I'm reading this right, yeah, when folks pay us their fees, we're actually helping them get their loan forgiven.
That's right. That's a great way to look at it.
So I just want everybody to know we are prepared to help you to the full extent possible. Right.
Right. So there was a lot of confusion the first time around. So this new law does provide a lot of clarity about the forgiveness and what's taxable and what's not. So when round one was first announced, it was understood that loan forgiveness would be non-taxable. Well, that was great.
There we go. Yeah.
Oh yeah, thank you.
I think that's where you wanted me to go.
Thank you. Yes, that's where I'm going.
Okay.
But then when Treasury wrote the rules, they put in this language that says your expenses that you pay with those loan proceeds that are forgiven are non-deductible. So what they did, they essentially made the forgiveness taxable by writing the rules that way. So this change takes it back to that original intent, and you're able to, so your PPP loan forgiveness is tax exempt, and now you're allowed a full deduction for the expenses that you pay with those proceeds. So go ahead, Paul.
Yeah, Robyn, if I can just jump in there to put this in sort of context. Back over the summer, we ran that survey of our clients that were able to get PPP loans, and we were able to identify at least $10 million of PPP loans that, as a collective group, our clients were able to take advantage of. And so, we've been sweating this second bullet about the full deduction of expenses. We've been sweating that the entire year because we knew that if those rules didn't change, that translated to a tax bill due this April 15th of anywhere between $3 and $3.5 million. And as this bill was reaching the finish line, and then there was a delay over the that last weekend of the year. We were sweating this because we knew this was a game changer for a lot of our clients. And so when that finally got passed, man, I don't know about you, but I felt a burden lifted off my shoulders.
We popped champagne at my house. I don't know. That's how nerdy we are. So that is huge. That's huge for our small businesses. And then finally, we will be receiving this simplified forgiveness application for loans less than 150,000 or less. So that's been talked about. It was talked about forever. We don't have the form yet, but it is coming. And it should be much, much easier than the full forgiveness application that requires so much detail and so many calculations. So that's also a big win for our clients. There was also some clarity provided. There was some confusion about this 8 and 24 week period. Say that you met forgiveness with 14 weeks of expenses. This just clarifies and says your forgiveness period ends anytime between 8 and 24 weeks. And so, if you hit 14 weeks and you've got full forgiveness, you can go ahead and apply. You don't have to wait and use that full 24 week period.
Great.
So Paul, I think I forgot who's talking about emergency grants. Is that you?
I was going to jump back into the EIDL grants.
Go for it.
So, you might remember, when this whole, when this all kicked off and the CARES Act was passed at the end of March, and, we started having those series of webinars that began in April. One of the relief programs was this EIDL Emergency Grant, which required you to actually begin the process of applying for an EIDL disaster loan. EIDL stands for Economic Injury Disaster Loan. It's an SBA program. It was not created new for the pandemic. It's been around for a long time. And so whenever a community or a region has a flood, a tornado, or hurricane, SBA will roll out these EIDL programs in those impacted areas, because it's an economic injury disaster loan. So early on, the pandemic was identified as an economic injury incident. And so the SBA rolled out for qualified borrowers this disaster loan program. So you had to start the application process, and you got to a certain point where it said, do you want to apply for an EIDL emergency grant, which under the CARES Act was $10,000. And so you'll remember in our early webinars, we were telling everybody, go online, apply for your $10,000 grant. It's a gimme. It's there. It's readily available. And in fact, the CARES Act said it was supposed to be funded within 72 hours of your application. Well, we know now it was nowhere close to 72 hours. It took weeks for a lot of people. And then the SBA changed all the rules. They said, yeah, $10,000 is what the act says, but we're going to apply it as if it's $1,000 per employee. And so we had a lot of clients that, we were saying, go get your 10, and then they were winding up getting 3. And it was like, what the heck? So that's why today we're talking about, these are the rules. We're sharing with you information in the bill, but we're always hesitant about the rules that the SBA and IRS might come out with. So, one of the things in the act made it clear that these EIDL emergency grants don't reduce your PPP loan forgiveness, which was in the original rules that the SBA wrote on this program, that if you got one of these EIDL emergency grants, they were going to ding you on your PPP loan forgiveness. And so there's a lot of folks that have applied for their forgiveness. They were told they owed a little bit of money because of these EIDL grants. Well, this bill retroactively amends the forgiveness and told the SBA to contact all of those borrowers, and you'll probably hear from your bank, to contact all those borrowers to let you know you can get that money back. Again, we don't know how fast that's going to happen. We don't know what the procedure is to get it back. But I would tell you, if you're one of those folks that had your forgiveness reduced because you got one of these EIDL emergency grants, if you've not heard from your lender ought to be hearing from you to make sure, so that they know you're entitled to a refund of that money. So I would strongly encourage you to make sure your lender knows you might be entitled to a refund. They also clarified that these EIDL grants are tax exempt income, which is a change because we were told all during 2020 that these grants, you're going to have to pay tax on them. So now it's tax exempt income, and it doesn't reduce your forgiveness. So 2 really big wins for those folks that took advantage of that early EIDL grant program. Well, you'll remember at the beginning of this presentation, I told you they appropriated an additional $20 billion to resuscitate this EIDL emergency grant program, and they've extended it through the end of 2021. It's not very robust, may not be pertinent to a whole lot of people, but for folks who are in what's referred to as a low income community, and that's a term that's defined in the Internal Revenue Code. I'm not going to get into a lot of detail about that. It's basically areas that have a poverty rate of 20% or more, and then there's a whole lot of other technical rules for that. If those recipients applied for the $10,000 original grant and they got dinged because it was based on $1,000 per employee, the bill says those folks can go back and get the gap. So if you apply, if you thought you were going to get 10 and you got 3, the SBA will be allowing you to go back and get that $7,000 difference. Basically, Congress said you should have gotten 10 just the way the law was written. Now, there is some confusion. What about people that aren't in a low income community who applied for the 10 and only got 3 or 4,000? Can they go get the gap difference and get that money? The law is unclear on that. It appears that there's priority given to original recipients that are in these so-called low income communities. And it's not really clear if people outside those low income communities can also receive that difference. That's something we're going to have to wait to get some more guidance on. We've seen conflicting articles and blogs that sort of cancel each other out. So right now we're just saying, wait. If in fact it does turn out that you're going to be eligible to get that money, trust me, we will be sending out all kinds of announcements on that item. There is a new 10,000 EIDL grant program for businesses in a low income community who suffered a 30% decline in gross receipts during any 8-week period during that particular period of time. Those folks can now go get an additional $10,000 EIDL grant. Again, that's a need-based grant if you can demonstrate that 30% or more decline in gross receipts. Some of you may have had SBA loans last year, and you found out, hey, the government's actually making my loan payments for me. And I know from our standpoint, we were sort of caught surprised by this. I remember one client calling me up and saying, hey, my loan's being paid. by the government. And I was like, oh, no, they're just deferring your payment. And he was like, no, they're making my payments. And so this one sort of was under the radar for us until we discovered that the government, in fact, for certain loans, 7A, 504, and microloans, these are all SBA loan programs, that in the original CARES Act, Congress directed the Treasury Department to make payments on your behalf to the SBA for 6 months of principal and interest payments on your loans. So, this happened automatically. You didn't have to take any action on it. It took us a while to get up to speed to, what the heck was going on. What this latest bill did is revive that particular program. So those of you that were getting those payments made for you last year, beginning in February, they're going to make 3 more payments on your loan. So your February, March, and April payment will be made by the Treasury Department to the SBA on your behalf on that loan. And for certain hard hit businesses, and again, we're going to need to see the rules on this, you'll get an additional 5 months. So your May, June, July, August, September payments could be covered by this Treasury payment program. So again, we want to see what that definition is for those hard hit industries. But again, this is something you won't have to act on. It's being done on your behalf. They also opened up this program for new loans approved after February 1st. So, 3 more weeks from now, loans approved between February 1st of this year through the end of September will also receive that 6 months worth of payments. And we'll talk about that a little bit when we get to the action plan at the end of the program. One thing they did impose, with this expanded program is that they did say these monthly payments are capped at $9,000 per month. So it's not going to be a free for all. There is a cap on there. But also, again, in this act, they said these loan payments, which we thought were going to be taxable income to you, that these loan payments are tax exempt income as well. So, Robyn and I were talking the other day, this is like the tax trifecta. Your PPP loans are tax exempt income, your EIDL grants are tax exempt income, and now these SBA loan payments are tax exempt income. So, life is good. Of course, this is meant to help people get through this pandemic and suffering. But boy, these rules couldn't have come out any better than they did.
Right.
Okay, Robyn, why don't you talk to us about the Employee Retention Tax Credit Program?
I'll do my best. So some opening comments. We didn't pay a ton of attention to this the first time around because the rules said that if you received a PPP loan, you were not eligible for this credit. The majority of our clients received PPP loans, so this was not on the table for them. So you may not have heard a ton about this. So what's new? So a couple of things. They have made modifications to the original employee retention credit, and they have also developed a new and improved employee retention credit. So the one we're talking about right now expired December 31 of 2020. However, the new law says if you received a PPP loan, you may still be eligible for this credit retroactively. Okay, so let's talk about who's eligible. We'll talk about how it's calculated, and then we'll try to kind of tie it all together. So this credit was really designed to assist businesses who continue to pay salaries during either a shutdown, or for those businesses that experienced a dramatic, a 50% drop in gross receipts when compared quarter to quarter over 2019. And so the shutdown could be, it has to be government order, but it can be federal, local, or state. And if you were shut down for any period of time, that's a qualifying event, okay? Now, only wages paid during the time that you were shut down qualify for the credit. And if you had a more than 50% reduction or 50% or more reduction in your gross receipts, then you also qualify. So I think, Brooke, were you going to jump in and show people this is also something that that they can look in their QuickBooks to see if they might be eligible for this retroactively.
Did you want me to go back to the P&L? Is that?
It doesn't matter, or just talk about it, maybe show the PDF that shows where they can, that this is another thing.
Sorry, I was reading one of the questions that.
Oh, no, yeah, Brooke is monitoring our Q&A over there. So I'm sorry.
And Paul answered the question offline. I was kind of waiting to jump in with the question.
I'm sorry. I caught you
fit,
completely off guard. It's okay. I mean, they've already seen it. They don't.
No, I'll pull it up right now. I just didn't want y'all to think I was.
I tell you what, go ahead and pull it up, and I'm going to keep talking, okay? Because we've got 15 minutes left, and I've got a lot still to cover. So you can look at your accounting software to see if you think you might qualify for this retroactively. So the maximum credit is $5,000 per employee. An interesting caveat, if you have 100 or fewer FTEs, then all of your wages qualify, okay, if you've met one of these conditions. But if you have more than 100 employees, only the wages that you paid for people to stay home qualify. So if you have more than 100 employees, you're going to have to take a closer look. It's a bizarre rule, but that's the way it is.
Robyn, if I can just pause you for just a minute there,
sure,
because I can't share the presentation while Brooke's sharing this. So let's just,
okay.
I think the point we wanted to make, Brooke, go ahead and talk about, Craig's landscaping service here and the retroactive tax credit, the qualification.
So that in the second quarter, he was over the 50% for second quarter of 2020.
Yeah, so if Craig's landscaping service got a PPP loan last year, originally they were told, well, you can't apply for the employee retention tax credit. Now the rule says, yes, you can. We can go back and retroactively see if they qualify. So for Craig on his particular company, he's got two things he needs to look at. One is if he got a PPP loan last year, should he go get a second draw loan because he qualifies? And should he evaluate his qualification for this retention tax credit because now he qualifies? So, a little bit of work that needs to be done there.
Yeah. So, and Brooke, keep that example up for just a second. So, so he qualifies. So under this, for the old employee retention credit, he's got a 50% reduction in Q2. So that's his qualifying event. What draws somebody out of qualifying, so they continue to qualify each quarter until the end of the quarter, in which they jump back to 80% of gross receipts when compared to prior year, if that makes sense. So, yeah, okay, good. Brooke, anything else on that?
I don't think so.
Okay. Let's see. All right, where was I? Okay,
I stopped sharing, Paul, so you can.
Okay.
Yeah, I've got it up.
Yeah. Okay. So, so here's the biggest thing on this. So you can't double dip. So if you can't use wages that qualified for PPP forgiveness as qualifying wages under this employee retention tax credit. So you can't double dip. We don't have any idea how this is going to work, and we don't know how it's going to be applied for. So hold tight. All we know is that it's retroactive. This credit and the new employee retention credit are both claimed on your quarterly 941s. And so, I don't know if that's going to mean going back to amend. We just have to wait and see. All right, so hold tight.
Yeah, I think, Robyn, that's the important thing is there's really two things we're waiting on. One is how the heck do you claim this retroactive credit? Yes. And then this thing about duplication of wages. The bill from Congress just said you can't duplicate wages. Well, what the heck does that mean? And
yeah, how are we going to figure that out? But anyway, more to come on that. So let's move on to the new kind of the enhanced credit. So this credit, like I said, the original credit expired December 31st of 2020. So this credit applies from January 1, 2021 to the end of the second quarter, 2021. So it's forward looking. It is not retroactive. So take a look at the eligibility now. So that percentage decline that qualifies you for the credit has been lowered to 20%. So down from 50%. So I think that's going to jump a lot of people into qualifying for this credit. So if Q1, Q2, 2021 receipts as compared to 2019 have dropped by 20%, then you're going to qualify for this credit. Again, if you're getting a PPP second draw, there can't be overlap there. So we'll have to just wait and see how that works. And then again, you qualify if if your operations have been suspended.
So Robyn, if I can just jump in here real quick.
Yeah.
Because I was surprised when I first read this, it said, you compare your Q1 and Q2 revenues for 2021, you compare them to 2019. And at first I was like, did I read that right? Because I would have thought you would compare it to the prior year, 2020. But understand, Congress is trying to make this a real benefit.
Right.
If Q1 and Q2 for 2020 was negatively impacted by the pandemic, this would be a hard item to qualify for. So they're allowing you to compare it to 2019 because that was a pre-pandemic year.
So the last normal year of business, right?
Right.
Yeah. So one interesting thing, there is an election to compare, instead of comparing, there's an election to compare your fourth quarter 2020 revenue to your fourth quarter of 2019 in order to qualify for the first quarter of 2021. So that is also something that you can take a look at right now to see if you think you might qualify by making the election to look at Q4 2020 instead of first quarter 2021 when you're comparing back to 19. If you weren't in business during a quarter in 2019, you can substitute quarters from 2020. So all is not lost if you weren't in business in all of 2019. There is a little caveat there that helps you out. And then the credit, rather than being 50% of qualified wages up to a maximum of $5,000 per employee, the credit goes to 70% of wages not to exceed $10,000 per employee for 2 quarters. So instead of a $5,000 per employee limit, it's a $14,000 per employee limit. And then, like I mentioned, so both of these credits are claimed on payroll tax reports. So a credit for Q1 2021 credit for Q1 2021 would be claimed on a 941. I think those are not due till April. Is that right?
Right.
Yeah, the quarterly report due in April. So you've got some time on that. Okay, that all makes sense?
Okay.
It's complicated. Go ahead, Paul, anything else to add on that before I try to wrap us up here?
Yeah, I was going to jump in and, there's kind of this, what role do we play in this particular process? I go back to the PPP loans. We can help you figure out if you're qualified to apply for the first draw or the second draw loan, but it's you working with your lender that has to actually execute on that. Similarly, with this employee retention tax credit, we can help you determine if you're eligible based on these revenue declines. But in terms of the execution and claiming of those credits, that's you working with your payroll provider, because these are payroll tax credits. And it's your payroll provider that has to really help you execute and take advantage of these items.
Right. Yeah, that's exactly right. Okay, I'm going to fly through this slide because I want to get to the kind of next steps and what to do now. So there are a handful of other items that were in this new law. So if you remember, there was the Families First Response Act, Coronavirus Response Act, required employers to pay wages to employees who were on leave for various COVID-related reasons. So it was this expanded sick leave and family medical leave, and that was mandatory through the end of 20. And so it is voluntary now for employers to make those payments, to continue to pay those wages to employees if they're out under those qualifying, if they meet those qualifications to be out. It's not mandatory, it's a voluntary paid sick leave. But if you choose to make those payments, the credit has been extended through the end of March. And again, that's a credit that's taken on your payroll report. So you'll work with your payroll provider on that. If you don't itemize your deductions, you are allowed a $600 deduction for 2021 for any charitable contributions that you make. That's up from $300 over last year. And then in an effort to help the restaurant business, which everybody knows has been hit so hard, The 50% deduction for meals has been increased. You get a full deduction for business meals rather than having those limited at 50%. And that applies for 2021 all the way through the end of 2022.
So Robyn,
yeah.
can I just stop you right there? Just as a historical context on this.
Yeah.
We've all gotten used to meals being 50% deductible. That rule was enacted in 1986. And I'm probably one of the few people on this call today that was even out of school in 1986. So, this is one of those things where I'm going to have to rewire my brain because for 44, let's see, 1980s, I'm trying to do the math in my head, 40 years plus, it's been 50%. And now I've got to like stop myself. Oh, it's 100%.
Right.
For 2 years.
For 2 years. Yeah. Well, that'll be something to watch for. It's like changing the due date of the C Corp return, right? I still can't get that one out of my, still.
Hey, Paul, I can help you with that. Does that mean that Mueller Pie is buying lunch today?
Oh. Yes, I think so. Great idea, Brooke.
On a remote basis, yes.
Great idea. Great idea. All right. And then lastly, employers are allowed to, they don't have to, but if they want to let their employees roll their unused flex spending account dollars. So typically, it's use it or lose it. And former rules, I think, limited it, let you roll over like $500. And now you can, employers don't have to, but can let their employees roll over those unused flex spending accounts from 20 to 21, and then again from 21 to 22. So those were a few other small items that were added. All right, so what do we do now? All right, so here's what we recommend. I think the first thing you need to do, take a look and see if you're eligible for a second draw on your PPP if you already got one. So you're going to look for that 25% reduction in gross receipts. If you're a newly eligible entity, or for some reason didn't get your first PPP loan, go ahead and contact your lender, see if they're going to be participating in whichever program it is that you're going for. PPP first draw, PPP second draw. I don't know that lenders are going to distinguish. They're probably just going to participate. I would go ahead and start gathering those payroll records if you think you qualify to determine the amount of that PPP loan. And then go ahead and start looking to see if you think you have wages that you paid in 2020, in excess of what your wages paid that you're using for forgiveness. If you qualify under that 50% reduction in gross receipts for 2020 over 2019, to see if you qualify for that original retroactive employee retention credit. And if you think you qualify, you're going to have to wait. But there's no reason to not look and go ahead and see if you think there's some money there. And then we'll be pushing out guidance and rules and all that just as soon as we have it. And then I would take a look and go ahead and look at your fourth quarter 2020 gross revenue as compared to fourth quarter 2019 to see if you qualify for this enhanced employee retention credit, the new one that expires at the end of June. Now, if you don't qualify based on fourth quarter 2020, looking back to fourth quarter 2019, then wait, and it's forward looking, and you can see if you qualify first or second quarter of 2021. And then lastly, if you're considering applying for one of these SBA loans that they're going to make, that Treasury is going to make payments on, apply. See if you can, get that money, and those payments will be made up to $9,000 a month, for potentially 6 months if you get in and get that loan before February 21st. So we're considering borrowing money.
Well, Robyn, you want to make sure the loan isn't approved until February 1st.
Ah, okay.
Yeah.
So it's not funding date, it's approval date.
It's approval date. Yeah. But if like Robyn said, if you were considering a loan, this would be the time to get the ball rolling.
Okay, good point. I'm glad you brought that up because I didn't realize it was approval date, not funding date. So you'll want to watch that.
Yeah.
Seems like there was something else I wanted to say when you were talking about something about what to do next, and now I can't remember what it was.
I think we were. I think I already mentioned it about the need to make to get your accounting caught up.
Yeah, maybe that's what it was. Okay.
Because if you haven't done your fourth quarter accounting for last year and you try to do these comparisons, it's garbage in, garbage out. So
yeah,
be careful.
Yeah, so that's what we see as the next steps. There's going to be some waiting and watching, but there are some things that you can be doing now proactively to kind of get the ball rolling on some of this. So as always, email us. We do have a special email address for COVID-related questions, covid@mpa.cpa, and then please continue to check our website. Note our new web address at mpa.cpa. We'll continue to push out information. And then Paul, you're going to put this webinar out there as well if you want to go back and take another listen to anything that we've talked about today.
Yeah, we will record this webinar and we'll send the file to the people that were on this particular webinar so that you have it readily available. We will also post it to our YouTube channel, which is Have an IPA with a CPA. We'll have that posted probably this afternoon on that YouTube channel. So you can certainly access it there as well. Brooke, do we have some Q&A that we need to cover?
So there was the one question, Paul, you already answered it.
Okay.
I didn't know if you wanted to.
Yeah, we had a question. The person asked, has anything changed in the PPP2 program for sole proprietors with no employees that had line 31 income on their Schedule C above $100,000? The original program limited the PPP loan for those sole proprietors to no more than $20,833, which I'm not going to get into how it got there, but it was based on that $100,000 income cap. My response back to that individual was, for the most part, the loan should be the same, but because of some of those expanded benefit costs, your loan could be slightly higher this second go around.
Yeah,
but it'd be pretty much the same.
Yeah, and I think Brooke is answering another question about how we enter PPP proceeds and EIDL into QuickBooks.
Okay.
Yeah. So when you record those deposits, there's two different ways of thinking. When we started doing this 9 months ago, we were saying to record them as a liability, because it is, until it's forgiven, it is a liability. And then we kind of switched gears a little bit and kind of have it as an other income so that it's not tweaking things and you see it on your P&L down as other income. So I would recommend one of those, especially if it's under the $150,000. I would just move it over to the other income. Do you guys agree with that, or do you still want it alone?
Yeah, Brooke. In fact, when you move it to other income, I would encourage you to create a new account in your chart of accounts and call it tax exempt COVID income, something like that, so that we see it when we're doing the tax return. Otherwise, if it gets buried in just other income, we're not going to know necessarily that is tax exempt income. So help us help you and get that thing clearly indicated on your chart of accounts.
I was also going to say, when you do move it, when you do record it, to record that deposit to the other income or the tax exempt COVID one that Paul suggested, please put in a description. If it's EIDL, if it's PPP, anything. Actually, for anything you put in other income, it'd be great to have that description for us. So when we go, we won't be calling you saying, what is this?
What the hell?
Go ahead and put in that memo in the description. Give us an idea of what it is for when we go look at it to do your taxes.
Yeah.
Anything else, Brooke? Any other Q&A?
That is, wait, maybe one more. Nope, that's the only one I've got.
We still have quite a few callers on. Any other questions? If you guys want to,
and of course we gave
chat over there.
And of course we gave you the COVID@mpa.cpa email box. We're monitoring that continuously to make sure we're getting that information out as quick as possible when you need it.
Yeah.
Okay. Well, if there's no other questions, we thank you all for joining us this morning. We think this was just tremendous. We were so thrilled when the COVID relief bill was passed. Stay tuned. I believe we're going to see, because of the situation with the Senate runoffs in Georgia, there's heightened expectation for another COVID relief bill, perhaps later this month, end of February. Obviously, we have no idea what might be contained in there, but we will be doing our best to do a deep dive, do the analysis, get that information out to y'all, so that you get, you get the straight scoop is what we hope. So thank you all for your attention today. And we look forward to working with you during this upcoming busy season. And Happy New Year. Let's be safe and stay healthy.
Absolutely. Bye, y'all.
Bye.
Bye, everyone.